In the late 1980s, Vlasic wasn't just another grocery brand. It controlled more than a third of America's pickle market and generated hundreds of millions in annual sales. Then, in just a few years, it collapsed into bankruptcy, triggered by a single decision that looked brilliant on the surface. But before we break down how one $3 deal unraveled a decades-old empire, make sure you like and subscribe. It helps support the channel and allows these deep dive documentaries to keep coming. Chapter 1. From Immigrant Kitchen to American Shelves. Vlasic's story began far from corporate boardrooms. Frank Vlasic, a recent immigrant, arrived in Detroit in the early 20th century and did what many immigrants did to survive. He relied on a skill he already had. He made pickles. At first, the business was small and local, selling jars to fellow immigrants who wanted familiar food from home. The product wasn't unique, and the operation wasn't ambitious. It was steady, modest, and artisanal. For decades, Vlasic remained exactly that, a functional but unremarkable pickle business. It produced a commodity product in a crowded market where most consumers couldn't distinguish one brand from another. Success, if it came, would have to arrive from somewhere else. That turning point arrived in the 1960s. Chapter 2. The marketing bet that built a brand. When Frank's son, Bob Vlasic, entered the business, he brought a radically different mindset. Bob wasn't obsessed with production. He was obsessed with perception, and the timing couldn't have been better. The 1960s marked the birth of modern branding, when television, radio, and print advertising became powerful tools for shaping consumer behavior. Bob understood something most food manufacturers ignored. Advertising didn't just sell products, it created preference. He invested heavily in marketing. Vlasic ads flooded newspapers, radios, and television screens. Pickles, once interchangeable, suddenly felt familiar and trustworthy. The strategy worked. By the late 1970s, Vlasic controlled over a quarter of the US pickle market and generated more than $100 million in annual revenue. Pickle consumption was still rising, fueled by population growth, immigration, and diets that hadn't yet turned against salt. Vlasic had transformed a low-margin commodity into a premium brand built on loyalty. That success attracted attention. Chapter 3. Acquisition and the Seeds of Decline. In 1978, Campbell's Soup Company acquired Vlasic for $35 million. On paper, the deal made sense. Pickles were still growing, the brand was strong, and Campbell's knew how to scale food businesses. Throughout the 1980s, Vlasic continued expanding, eventually reaching roughly $200 million in annual sales and a staggering 36% market share. But while Vlasic's sales looked healthy, the broader environment was shifting. By the early 1990s, consumer preferences began changing. Public health messaging increasingly framed salt as dangerous. Low-fat and health-conscious diets surged. Pickles, salt-heavy and nutritionally limited, stopped being a growth category. For Campbell's, this created a problem. Public companies aren't rewarded for stability, they're rewarded for growth. Vlasic had become a flat business in a portfolio that demanded expansion. And instead of fixing that problem patiently, Campbell's chose a financial shortcut. Chapter 4. The spin-off that rigged the game. Campbell's decided to spin Vlasic off into a separate public company, but not before extracting value. The spin-off saddled the new Vlasic Corporation with roughly $500 million in debt, money that flowed straight back to Campbell's. Overnight, Vlasic went from a stable brand to a leveraged entity burdened with enormous interest payments. More than half of Vlasic's operating profits would now go towards servicing debt. To lead this newly independent company, Campbell's appointed an internal executive with no prior CEO experience. It was a financial instrument designed to absorb debt. The incentives were clear and dangerous, not because the market demanded it, but because the balance sheet did. Chapter 5. The Walmart Opportunity. Under pressure to reignite growth, Vlasic's leadership searched for scale. That opportunity appeared through Walmart. By the 1990s, Walmart wasn't just a retailer, it was the most powerful buyer in America. Securing shelf space meant volume, visibility, and revenue. Losing it could cripple suppliers. A Vlasic sales executive, working with a Walmart buyer, proposed something unprecedented: a gallon jar of Vlasic Pickles priced at $2.97. The idea violated every rule of premium branding. Absurdly cheap and impossible to miss. Customers loved it. The product became a spectacle. Shoppers didn't just buy pickles. Walmart rolled the product out nationwide, and sales exploded. At its peak, Vlasic sold roughly 240,000 gallons per week. On the surface, the growth problem was solved. Chapter 6: When volume becomes a trap. The first issue was margins. Traditional pickle jars earned 25 to 30% gross margins. The gallon jar earned almost nothing. Vlasic was moving massive volume for pennies per unit, turning factories and farms into high-effort, low-return machines. The second issue was brand erosion. Vlasic had spent decades convincing consumers it was premium. A $3 gallon jar destroyed that perception instantly. Price anchors shifted. Customers no longer saw Vlasic as better. They wondered why they had ever paid more. Third came demand cannibalization. Pickles don't expire quickly. By selling customers a year's supply at a discount, Vlasic eliminated future purchases of profitable products. High-margin quart jars were replaced by low-margin gallons. Then came the most dangerous problem of all: dependence. Over 30% of Vlasic's revenue now flowed through Walmart. Entire cucumber farms were dedicated to serving a single retailer. The company no longer controlled its own fate. Chapter 7: Walmart closes the door. When Vlasic executives realized the situation was unsustainable, they flew to Walmart's headquarters to renegotiate. Walmart refused. The choice was blunt: continue the deal or lose shelf space entirely. Vlasic tried to wait Walmart out. Walmart waited longer. Eventually, Walmart conceded partially, allowing Vlasic to switch to a half-gallon jar at a slightly higher price. The change offered some relief, but not enough. Margins never returned to historical levels. Brand damage remained, and the debt clock kept ticking. Vlasic was trapped between a retailer it couldn't afford to lose. Chapter 8: The collapse becomes inevitable. As cash dried up, options disappeared. Debt markets tighten precisely when companies need them most. Vlasic couldn't refinance. It couldn't raise prices without losing customers. It couldn't walk away from Walmart without imploding. In January 2001, less than 3 years after launching the gallon jar experiment, Vlasic filed for bankruptcy. The once dominant brand was dismantled. Its assets were auctioned off to its longtime rival for $195 million, less than half the debt placed on the company at spin-off. Chapter 9: The hidden forces that sealed Vlasic's fate. What made Vlasic's collapse especially brutal was that even if leadership had recognized the danger earlier, reversing course was nearly impossible. Food brands operate under a different set of constraints than tech or retail companies. Once a price expectation is established in the consumer's mind, it becomes extremely difficult to undo. Shoppers don't evaluate food brands in isolation. They compare them instantly, subconsciously, and emotionally. The $2.97 gallon jar didn't just move units. It permanently reset what customers believed Vlasic Pickles were worth. Unlike luxury goods, food brands lack flexibility in repositioning. A car manufacturer can introduce new trims. A tech company can launch a premium tier. But a pickle is a pickle. When Vlasic tried to sell smaller jars at higher prices after the Walmart deal, customers resisted. They had already seen the brand sold cheaply at massive scale, and the perception stuck. What had once been a premium signal now looked like a markup. At the same time, operational complexity exploded. Supplying Walmart at national scale required massive agricultural coordination. Farmers planted cucumbers months in advance based on Walmart demand forecasts, locking Vlasic into fixed supply costs. If demand slowed or prices dropped further, inventory piled up. Waste increased. Flexibility disappeared. The business became brittle. There was also a competitive ripple effect. Other retailers began demanding similar pricing. Grocery chains questioned why Walmart customers could buy a gallon of Vlasic Pickles for $3 while their shoppers paid more for smaller jars. To maintain shelf space elsewhere, Vlasic faced pressure to discount across the board. The Walmart deal didn't just dominate one channel, it infected the entire pricing ecosystem. Employees understood the volume surge wasn't translating into profitability, but leadership had no alternative engine for growth. The debt load meant standing still was not an option. Every quarter demanded higher sales, even if each additional unit made the company weaker. Growth became destructive instead of healthy. This is where Vlasic's situation crossed from risky to fatal. The company wasn't failing because consumers stopped buying pickles. It was failing because success itself had become unprofitable. When Walmart finally allowed the shift to a half-gallon jar, the damage had already compounded. Brand equity was diluted, pricing power was gone, and debt obligations hadn't changed. The business no longer had a path to recovery, only different speeds of decline. Vlasic's story reveals a deeper truth about scale-driven partnerships. When one party controls access to customers, logistics, pricing, and volume simultaneously, the supplier stops being a business and becomes infrastructure. Chapter 10. Why this failure was written from the start. Vlasic didn't fail because of one bad idea. It failed because multiple structural pressures aligned. Financial engineering prioritized short-term extraction over long-term stability. Growth was chased in a market that no longer wanted it. A premium brand was sacrificed for volume. The $3 pickle jar wasn't the mistake. It was the symptom. The real failure happened earlier, when incentives were distorted and patience disappeared. Vlasic's rise proved that branding could turn even the simplest product into a powerhouse. Leverage and control slip out of alignment. One deal promised salvation. Instead, it rewrote consumer perception, destroyed margins, and handed control to someone else. If you want to see another iconic brand undone by forces it underestimated, watch the documentary on the decline of Party City next. And if you're new here, like, subscribe, and tell me which rise or collapse should be uncovered next.